Hello everyone, welcome to my channel again. Let us talk about a very special concept today. Initially I have planned not to tell this concept because it is little confusing, but just that I got an idea. If I put forward the concept in front of you, then even I will get more clarity while explaining the same to the viewers. So thank you for supporting me, thank you for liking the earlier videos, thank you for sharing them with your colleagues and professional fraternity, and thank you very much for all your lovely comments. Let us jump into the concept. So now we have been discussing about value and valuation. We all know that value is a consideration or a monetary number assigned to a thing or an article or a product or a service. In our case, it is business. Valuation is the process of identifying and assigning such amount of consideration. To that part we are sure. Let us talk about business value, enterprise value, and shareholders value. Okay, I'm just writing down these three words: business value, enterprise value, and shareholders value. Okay, primarily or fundamentally, the value of a business comes from value creation because of more return on the capital than the cost of capital. Okay, I'll repeat it again. The value of the business or the value of an entity is fundamentally derived from more return on capital employed than the cost of capital. So what are we talking here? Return on capital employed shall be greater than cost of capital. Cost of capital is generally called as weighted average cost of capital. So it's tricky. I will try to keep it as concise and as precise as possible. Let us talk about capital first. Capital is amount either in cash or in kind which is put into the business at the initial stages of starting the business or during the phases of running the business, which helps run the business. So initial phases or running the business. If you are infusing capital in the initial phases of the business, usually we use that for buying the fixed assets. So we call that as a fixed capital. If we are infusing the capital or introducing the capital for the running of the business, we use it for running costs, especially variable costs. So no, running cost is not just the variable cost. There can be a fixed cost also in the running cost, example overheads, rent, etc. But just for our understanding, I am just saying this running expenses will be met with the running capital, which is called as working capital. Perfect. Now that we have understood capital, let us look at what is cost of capital. There is a huge concept of weighted average cost of capital, how to calculate it and how do we arrive at, that's for the later point of time. But now the cost of capital comprises of two components. One is cost incurred for procuring the capital and cost incurred for keeping the capital in the business. Yes, let us talk about a loan. I am an entrepreneur. I am infusing 5 lakhs from my pocket and I am seeking 25 lakhs of bank loan from the bank for buying of the machinery. So 5 lakhs is my own capital and 25 lakhs is my borrowed capital. For borrowing 25 lakhs, I have to spend processing charges plus some percentage shall be paid as a stamp duty plus some percentage should be paid to central government as a part of insurance, or you can say as a part of CGTMSC guarantee fees. So insurance and fees. So all this is called as procuring cost, whatever I have incurred. And for keeping the capital in the business, I have to pay interest or I have to pay some kind of annual maintenance charges, etc. etc. So keeping cost is interest. Again, I am saying the definition of cost of capital is not this one. The calculation approaches, the method to compute maybe as per CAPM or maybe as per any other methods, those and all we will discuss at a later point of time. But now, just for understanding, the cost of capital comprises of two components. One is procuring cost and another one is keeping cost. Procuring cost is processing fees, percentage of stamp duty, percentage to be paid as an insurance or percentage or guarantee fee, etc. And keeping cost is equals to interest or annual maintenance charges or etc. etc. Right, this is the cost of capital. Right, cost of capital, this is out of pocket cost of capital. Out of pocket. There is a chance that cost of capital may be implied or implicit. What? Implicit or implied? In our example, we have borrowed 25 lakhs and I have introduced 5 lakhs into the business. This 5 lakhs is out of my own savings, and if I would have kept the savings in any other kind of fixed income generating securities or variable income generating securities. Fixed income generating securities are already debt, bonds, T-bills, etc. Variable income securities are like shares, mutual funds, etc. So wherever the scenario may be, if I keep these funds there, I would have definitely got something in return on that investment. But however, since I am utilizing this 5 lakhs in the business, I am losing it. That is what we call as opportunity cost, which means the next best alternative cost for the amount that you might have invested elsewhere, you have invested in the business. So that is called as implicit cost of capital. When you are computing a value which means more return than more cost, it is ideal that you add your implicit cost also into the cost so that your value of the business can be clearly defined. Perfect. Now let us come to return. The concept of return is dependent on two factors. First one is at what level of financial statements you are looking. Second one is to whom or the stakeholders you are looking. So you should look at P&L statement and you should consider stakeholder level. Let us say I am looking at EBITDA, earnings before interest, tax, depreciation and amortization, which means stakeholders include debenture holders plus preference shareholders plus equity shareholders. Because it is an enterprise value, I am looking before interest, before taxes, before depreciation and amortization. So my stakeholders are debenture holders, preference shareholders and equity shareholders. Okay, now if I am looking at EBT, which means after interest, then I am just looking at preference shareholders and equity shareholders. If I am looking at earnings available for distribution to equity shareholders, then I am just looking at equity shareholders. So at what line item of your profit and loss statement and at what stakeholders you are involving defines your return. Now the return is EBITDA if you are considering stakeholders of debt, preference shareholders and equity shareholders. The return is considered as EBT if you are considering preference shareholders and equity shareholders only. The return is considered as earnings available after preferential distribution of dividend and to be distributed to equity shareholders only if you are taking equity shareholder. So this 3 levels of return we are expecting at. Okay, now let us look for value. So what do you understand by value? Value is equals to return on capital employed is greater than, which means definitely higher number. So I am subtracting it from weighted average cost of capital. Okay, let us look at debenture holders plus preference shareholders plus equity shareholders. So return on capital employed is equals to EBITDA minus weighted average cost of capital. So here the cost of capital includes interest paid to debenture holders plus preferential dividend to the preference shareholders plus dividend to equity shareholders. So all the components we have to subtract and then whatever we get shall be the value of the, is it value of the business or it is value of the shareholders? Definitely this is value of the business, or you can say enterprise value. Enterprise value. Now let us look at just preference shareholders and equity shareholders. So we'll take EBT and we will just subtract. The interest component is not taken into consideration. Dividend payable to preference shareholders plus dividend payable to equity shareholders is equals to shareholders value. Now let us go to the third concept. If I am just looking at only equity shareholders, now earnings available for distribution to equity shareholders minus dividend to equity shareholders is equals to equity shareholders value. Yes, I think I have made clear the concept. Kindly comment below if something requires more significant or more detailed elaboration. I'll just try to put that again in the videos. Now let us conclude this concept by just posting or by just understanding one specific scenario. What does it mean? What does it mean creating or enhancing shareholders value? The primary objective of the business is to create and enhance shareholders value. That means increasing the current market price. Current market price. When there is a rise in the current market price, then the shareholder can go and sell his shares at a higher price than the cost that he has incurred to buy the share. So that gives you increased shareholder wealth or creating shareholder wealth. But to just give a note, when we are talking about the current market price only, it doesn't mean we are just looking at the current shareholders only. If you create the value stays in the business with the enterprise, and it is also the future shareholders value. So when you create a shareholders value, unless until there is a long term diminution that exists for the future shareholders also. Hope you understood the concept of value in terms of return and cost of capital. Let us catch up with another concept. Jai Hind. If you like this topic, please give a thumbs up for the video. If you know someone who wants to learn these concepts, share the video with them. And if you have not subscribed to my channel, subscribe to my channel and click that bell icon to keep updated for notifications of the content. Thank you. Jai Hind.